Hi everyone, Natu here, back with another video. And in this video, I'm going to show you how to leverage your time when you're working on closing $10 million plus either multifamily acquisitions or funds. There's a big problem I'm seeing in this space because there's some people who are not business owners and they approach the capital raising world when they're raising for the first $10 million as more as an employee or somebody who is an individual investor. Because many people who we work with, a lot of them are real estate investors that are looking to manage their first fund or raise money to acquire a deal, a one-off transaction of $8 million, $10 million, $12 million, and even beyond that. And so how do you actually, do this with the right mindset? Well, I'll show you how to get it done right now. So there are a few problems because many people approach this stuff thinking like an employee, when they're working on raising capital here. Because one should always understand how to leverage their time, because the problem with time is that it's limited, right? And so imagine this is you, and I'm just drawing this out. So imagine this is you, and you want to raise, let's say 1 million from an investor, and you want to raise 1 million from an investor. So to do that, you just rely on, and this is really sad, and I see this, people rely on cold calling all the investors. So let's say there are a bunch of investors. These dots represent investors, people that could potentially invest. And somebody would focus on cold calling all of them, like one at a time. And then when that doesn't work, then they'll work on going on LinkedIn. So this is call. And then they'll work on going on LinkedIn and then doing the same thing for each of these people all the way to the end. They'll do this all the way to the end. Then they'll focus on going to email. And then they'll do the same thing for this. And then meanwhile, they have a one-to-one relationship. So they have a one-to-one leverage relationship with their time and the results that they get. So the problem is, one thing that helped me break through this mindset is to think probabilistically, is to think in terms of probabilities and expected values, right? So, for example, if somebody has let's say you're selling your deal, same thing with selling a contract, anything. So let's say you have somebody that sells somebody, right? This person is selling somebody, and then this person, or even an investor or whatever, this can apply to anything. And let's say of all the people that they sell into the deal, there is a 25% chance of the deal closing. And this is really, we've already made videos on this, but we're just making it really obvious. So let's say that, there is a 25% chance of this guy closing a $1,000 deal. So that would mean that so depending on the amount of time, so now we're adding the time variable into the probability equation, the expected future value equation. So, and let's say for a certain period of time, so this is this many calls. So let's say it's like, so what expected value is basically multiplying value by probability. So it's multiplying value by probability. And when you multiply value by probability, then you can get something called the expected value. So now it's to get the expected value over time, based on the amount of calls that you do. So let's say somebody makes 10 calls a day. So 10 calls a day, and then each call, the average, we're not looking at bad days and good days or bad weeks or bad months or whatever. We're looking at the average overall, the median, or sorry, not even the median, the mean. So of this, they close 1 in 4. So we have 10 divided by 4, and then that's the average. So this would mean that if somebody spends, let's say they spend, and this is just a crazy example. So let's say they spend 10 hours. So let's say each call is 1 hour. So let's say each call is 1 hour. So 10 calls is 10 hours. That would mean that each call, so each hour, so 1 hour will be valued at approximately, move the decimal point back, at 250. So that means that the person's time is valued at $250 per hour. So, as Naval Ravikant, famous investor, said, he's a mentor of somebody called Tim Ferriss as well. He said that you want to set aspirational hourly rates for yourself, such that you do everything in your power to achieve it. Because if you just do this, and then let's say that you're working on a large deal, so some people are selling an investor on like a 100K deal, and they don't even know the probability of it closing because it's zero, but then let's just say 0.001, you want to multiply what probability you think it would happen by the amount of time the calls that you have to make times time, and then you can get not times time, over time, and then you get the amount of output, the probability of you closing the deal over a certain amount of time. And so this is how you manage your time, because this for many people is really low. And when you actually come to this conclusion, especially for small deals, this stuff is easier to track in small deals than it is to track in big deals, but you could still do it in big deals. Then what happens is you start to value time much more carefully. And then, let's say the best way to leverage it is to talk to somebody who was already experienced in closing deals and you already know their track record. Let's say you have like a salesperson who sells investors and so on, or registered dealing representatives. For example, in Canada, an exempt market dealer needs dealing representatives that can close people on the phone. Or let's say that you're in the United States, it's a FINRA registered broker dealer or FINRA registered agent or an investment banker. So you get somebody's track record and you say, over X amount of time. So what you want to do, you want to get the amount of time. So you want to get probability. So the probability of closing over the time. And the probability of closing is basically just like the amount of calls. So really it's the amount of calls per past track record. And then if you do this, or if you at least build the systems for you to get the right people on the phone at the right time, then you just have to spend your time first being the person to actually know about the deal so that your hour per time goes up. Because if you manage and if you find ways to build a system for you to get these people hitting the phones as much as possible, and then this is you, and then you're just really managing these people that have like a $250 per hour value on their time, then that means that your time will be valued. If you look at the aggregate of everything, then your time will be valued at 1,000 per hour. If you've built the system, so the key word is the system for you is that you want to position yourself where you're making as much per hour in potential. You're making as much as hour per possible by building systems to get people to do this type of work on your behalf, and to maximize. So that's one way, right? To get people that have high probability, so increase the probability of closing, probability of things closing, and then you want to make it so that you have as many tasks like ongoing. So basically because as much time, you want to buy as much time as possible. So you want to get as much time as possible. And that's pretty much it for this part, because if you're able to do this, then you wouldn't be using your own time to do that, to do a lot of this, make a lot of these menial decisions where you can just get somebody to sell investors on your behalf. So that's the first part. And that's why a lot of what Raises.com we do is we get people to build these systems so that, they have the team of capital raisers underneath the company. And they're able to sell at scale. So that's one way. The second thing is, because of all the time that is bought back, the person's able to make better decisions. Because Jeff Bezos, the founder of Amazon, said that it's more important. The most important thing is that for him to make a very few high quality decisions. And if you read a ton of cognitive biases, research would argue that decision fatigue is something that happens when you make many decisions and the quality of those decisions diminish because your brain can only do a few things at a time. And so you want to buy back time so you can make better, high quality So HQ, high quality decisions. And the better decisions you make, the better long-term things you're going to do, because you're going to be able to make decisions that have high leverage. And by leverage, you're going to be able to build better systems. So better systems of people, like as we mentioned, that can raise the capital on your behalf so that you maximize your time, because your time is the aggregate value of all of the time that their value is worth and all the tasks that their value is worth. You're going to be able to get better deals, so better systems, better feedback. So there's going to be better feedback. Because by feedback, I mean the better decisions you make, the better systems you're going to be able to build, and the better decisions you make. Because nobody can instantly, we understand that a lot of people are coming from the startups. They've started with something small. It's very hard for somebody to go from a small deal and then turn out and then delegate everything right away. So obviously it's not realistic for everybody. But slowly somebody can, quote unquote, crawl themselves out of hell by slowly chipping away at, getting one person under them to sell the deal and getting another slowly. And then over time, they're going to be able to, get a few deals closed, and then they'll use that money to get more people to do it on behalf of them. And then the third thing is really thinking long term. So you're going to have to think long term. And there's one example. So, for example, it's from this book, and I can't really remember the name of the book actually. Well, as soon as I remember it, I'll mention it in another video. But let's say somebody has a job, and then the person gets paid. Let's say the person gets paid $20 per hour. So let's say somebody gets paid $20 per hour at a job, right? So somebody gets paid $20 per hour. What they'll find is that some people, they may say, oh, paying a plumber, for example, to fix his pipe. So let's say a plumber costs $100 to fix the pipe, but they can fix it in like 1 hour. People typically would say, oh, I don't want to spend $100, or even let's say let's say 1,000. Let's put it in an extreme example, even $1,000. Some people say, oh, I don't want to spend that. And then they would say that's stupid to spend that money. Most people would say. So normal people would say it's stupid. But what business owners would do, and people that are really good at building wealth, what they'll say, they'll also keep into account the amount of time that they would spend building that, fixing this pipe. And so let's say that the person would spend, let's say 20 hours. So let's say this person would spend 20 hours fixing it. So this is like the person. So this is like you, for example. In this example, it's not really you, but it's just an example. And let's say this is the plumber. And the plumber would be able to do this in 1 hour. But you'll be able to do this in 20 hours. What most people don't do, most people just don't consider that if you just multiply the time that you take out by the amount of hours that you work, you're actually losing money. So the average money that somebody makes in an hour of the day, this is not a normal job hours. This is like the average money that somebody, quote unquote, is worth, quote unquote, per day, if you include everything. So that means that this person would be spending $2,000 when you include the value of the person's time. Whereas if they were to hire the plumber would it's 1-to-1 because the plumber would do it faster. You're actually saving $1,000 in value by delegating it to the plumber, because you're using that time back, and you're buying yourself time for you to be able to use that time to do other high leverage activities. So that's really the point. Overall, you want to make sure that you use your time wisely. You consider the cost of using something that saves you time versus the cost of using something that burns your time. You want to understand that you can leverage other people's time by looking at the aggregate value of their time, multiplying the probability so that you know what percentage chance of you working on a deal would close and what types of deals to work on. And then you also learn about the long-term effects of building good systems for you to be able to delegate and systematize your either capital raise, setting up your fund, closing your acquisition, so that you don't have to get stuck on the small stuff and think like a one-dimensional business, one-dimensional employee. You can actually build systems that can allow you to get the leverage that you need for you to win. So if this makes sense, let me know. If it doesn't, let us know as well. And if you're watching on YouTube, just hit that like button and subscribe and everything, so that you can get more like this, because we only show exclusive things to the subscribers. And so with this, we look forward to seeing you on the other side.